Hi guys, welcome back to my YouTube channel. Again, this is Giselle HRAS, and in this video, we will continue our discussion on dealings in properties. So, in our previous video, we have already classified what is an ordinary asset and what is a capital asset. So, we have already mentioned the rules, the tax treatment for ordinary gains and ordinary losses arising from the sale of ordinary assets. So in this video, we will focus our discussion on the sale of real properties classified as capital assets. If you're ready, let's start. So before anything else, I'd like first to have a brief recap on what we have discussed already in our previous video. So if you haven't watched it yet, I will link the video here. So please watch that video so you will have a knowledge on how to tax the gains or losses arising from the sale of ordinary assets. So when we say dealings in properties, this is all about business transactions or sale of properties. And when we say properties, these can be personal properties. When we say personal properties, these are movable properties like cars or equipment. So any movable properties are personal properties. This can also be incorporeal properties. When we say incorporeal properties, these are anything that has no substance, has no physical substance, like shares of stocks or rights. And another, we have real properties. Real properties, on the other hand, are immovable properties. These are permanently fixed in the land. Dealings in properties could be a sale of ordinary assets or a capital assets. And also recall that we have already discussed the ordinary assets. When we say ordinary assets, these are properties, any properties, whether personal, incorporeal, or real properties which are classified as inventories and also as used in business. When the property, whether personal, incorporeal, or real properties, are used in business or are classified as inventories, they are considered as ordinary assets. And they are taxed if it's personal properties, any gains or losses arising from the sale of ordinary assets are added to the gross income, meaning subject to the normal tax. And if it is a sale of real properties, this will be subject to creditable withholding taxes. So we have already discussed in our previous videos those withholding taxes, the 1.5%, the 3%, and the 5%. So please watch that video. And since these real properties are ordinary assets, any gains or losses are also added or deducted to our gross income. So in this video, we will focus more on the capital assets, which are, as we know, classified as non-inventories. So these are non-inventories. These are not held for sale. Or those properties, whether real or personal properties, which are not used in business. And they will be taxed. If it is a personal property, any gains or losses will be added to the gross income. And if it is a real property, it will be subject to the capital gains tax, which will be our focus in this video. So, as a brief recap, capital asset is defined by exclusion, meaning those which are not considered as ordinary assets are classified as capital assets, such as, other than those enumerated as ordinary assets, all properties not used in business, residential house and lots, your own family dwelling, your own family car, receivables arising from the sale of inventory, investment property. So these things, these properties are neither inventories nor properties used in business. Therefore, they are all classified as capital assets. So what will be our tax treatment for capital assets? Well, the answer is it depends. It depends on what kind of asset is being sold. The capital asset may be a real property or incorporeal properties, such as shares of stocks, or personal properties. When we say real properties, again, these are immovable. And this could be subject to 6% capital gains tax or 6% creditable withholding taxes if the sale is made to the government. Or if it is an incorporeal property, that could be subject to 15% capital gains tax if the stocks are not traded in the local stock exchange. If it is personal property, then it could be subject to normal tax. So, there are three things that we should remember on how to treat capital gains. First, we need to know what kind of property is being sold. Is it a real property? Is it an incorporeal or personal properties? So in this video, we will focus our discussion on real properties alone. So those incorporeal properties and personal properties will be discussed in another videos. Okay? So I really hope that you would also watch those. So let's focus our discussion on real properties. So real properties. As a rule, sale, disposition, barter, or exchange of real properties located in the Philippines, classified as capital assets, is subject to 6% capital gains tax. So that is very clear. Any real property located in the Philippines and are classified as capital assets are subject to 6% capital gains tax when sold. The tax base for the 6% CGT or capital gains tax is the gross selling price or current market value, whichever is higher. If sold to the government or any of its political subdivision, the seller can choose 6% CGT or 6% CWT. So we will have an illustration for this one by one. Let's have an illustration. Juan de la Cruz sold his agricultural land to Maria Katigbak for a price of 3 million pesos under the following terms. So there is a down payment of 1,200,000 and 3-year installment payments. That is 600 per year. So 600,000 per year times 3 years, that would be 1,800,000. So 1,800,000 plus 1.2, a total of 3 million. The land was acquired 5 years ago for 1,370,000 and now fairly valued at 3,250,000 at a time of sale. So let's first analyze the problem. Juan de la Cruz is a Filipino citizen, a resident, and Juan de la Cruz owned an agricultural land. He sold this land to Maria Katigbak for a price of 3 million. The terms requires Maria to pay a down payment of 1.2 and an installment per year of 600,000 for 3 years. The land was acquired 5 years ago and is now fairly valued at 3,250,000. So, first assumption, if Maria is a non-government or any of its political subdivision. Therefore, if it is not a government, if the buyer is not a government, the tax applicable will be 6% capital gains tax. So, first, we will compare the selling price of 3 million versus the fair market value of 3,250,000, and we will choose whichever is higher. So we will choose the 3,250,000 as this is the higher amount. So the capital gains tax shall be computed as 3,250,000 times 6% is equal to 195,000 pesos. So this 195,000 pesos is our capital gains tax and to be withheld by the buyer and remitted to the BR. So what could be the effect of the transaction? The buyer will only pay the price net of the capital gains tax, meaning Juan will only receive 3 million minus 195,000. So that is 2,805,000. So Juan will not expect a higher or the gross amount because Maria will withhold the tax. and Maria will be the one to pay and remit that tax to the BIR. To effect the transfer, the BIR will issue a certificate authorizing registration or the CAR, which indicates that the capital gains tax and other taxes have been paid with the BIR and is now ready for registration with the Registry of Deeds. So if you are the buyer, if you are Maria, you should be the one to withhold the capital gains tax. And you should be the one to remit and pay that tax to the BIR before you can secure a certificate authorizing registration. What is a CAR? This CAR is an official document to be presented to the Registry of Deeds. You need this document before you can be entitled to the ownership of that real property. If you are the buyer and you failed to withhold the tax and you failed to remit the tax to the BIR, you cannot be issued a CAR. And without this CAR, you cannot register to the Registry of Deeds, which in short, you cannot be entitled to the ownership of that property. It is your responsibility as the buyer to withhold the capital gains tax of 6% and remit the tax to the BIR. But remember, it is not you, the buyer, who is being taxed here. It is not your money. It is not your tax. The seller is the one who is being taxed here, not you. You are just a withholding agent collecting the tax from the seller. So assumption 2, if the buyer is a government or its political subdivision. So let us assume that Juan sold a real property to the government or any of its political subdivision. So Juan, in this case, the seller, has the option to subject the sale to 6% capital gains tax or to 6% creditable withholding tax. So in this case, we will follow the same computation. We will compare which is higher, the selling price or the fair market value. And in this case, the current fair market value is higher than the selling price. So the seller, Juan, can choose whether to subject the sale to 6% CGT or to 6% creditable withholding tax. So if the seller, if Juan, opts to subject to 6% capital gains tax, the capital gains tax shall be computed as 3,250,000 times 6%, and that is 195,000 pesos. But if the seller opts the 6% CWT or creditable withholding tax, the withholding tax shall be computed as 3,250,000 times 6%, that is 195,000 pesos. The tax as to amount is the same for whatever option, but there is a big difference. Okay? So, if the seller opts the 6% capital gains tax, the capital gains tax of 195,000 shall become the final tax, which means any gains or losses arising from such sale is no longer added or deducted to his gross income, because the capital gains tax is a final tax. And as the seller, you are no longer required to report your gains or losses to your gross income. But if the seller opts the 6% CWT, the creditable withholding tax of 195,000 shall be charged against his normal tax, the graduated rates. Meaning, any gains or losses arising from such sale is still added or deducted to his gross income. Okay? So if it is a capital gains tax, then that is a final tax. And as a seller, you are no longer required to report the gains or losses in your gross income. But if you choose the 6% CWT, you are still required to add or deduct the gains or losses on your gross income. And whatever the tax due is, you can use the 6% CWT against your income tax due. We have a computation about CWT in our previous video, so I really suggest that you watch that video so you would understand what is the effect of the 6% CWT. Let's talk about pacto de retrosales. A pacto de retrosale is defined as a transaction wherein the seller has the right to repurchase the property being sold to him or her. This is done in order to immediately transfer the title and ownership of said property to the vendee a retro. So, in a pacto de retrosales, there is actually a condition. For example, if I am the seller and I will sell my real property to a buyer, I would give a condition that I will sell this real property, but I will have a right to repurchase that property back. That is a pacto de retrosales. And in such case, the capital gains tax also applies to pacto de retrosale and other forms of conditional sale. Because there is a sale, there is a transfer of ownership. Therefore, capital gains tax is still affected. However, the capital gains tax is only applicable to the properties located within the Philippines and not those from abroad. So if we have a general rule, we also have an exemption. The sale, disposition, barter, or exchange of real properties classified as capital asset may be exempted from the 6% capital gains tax or the 6% CWT if the following requisites are met. So, number one, the capital asset sold was a principal residence. So, if the real property or the capital asset sold was a family home, a principal residence, and the taxpayer is a citizen of the Philippines or a resident alien, and the proceeds of the sale was invested in acquiring a new principal residence. So the seller would use the proceeds of such sale to acquire or to construct a new principal residence. And there is a notice to make such utilization was given to the buyer within 30 days from the date of sale. And the utilization of proceeds of the sale was made within 18 months from the date of the sale. And there is a cash deposit called escrow account with an accredited bank for an amount equivalent to the capital gains tax due. That should have been paid if not exempted. And the exemption shall be availed only once in every 10 years. Let's have an illustration. Napoleon sold his principal residence at a selling price of 5 million pesos, but with a current market value of 6 million pesos. The property sold was acquired for 3 million pesos 7 years ago. Napoleon intends to use the proceeds of 5 million in acquiring his new residence at a target cost of 7.5 million pesos. So in this case, the seller sold his principal residence. He intends to use the 5 million proceeds of the sale to acquire a new residence, in which, in his estimates, would cost him 7.5 million pesos. So assumption 1, Napoleon failed to meet any of the requirements for exemption. So since Napoleon failed to meet any of the requirements for exemption, he would be subject to capital gains tax of 6%. So the capital gains tax due is 6% of the 6 million. Why 6 million? Because even if the selling price is 5 million, the higher amount is 6 million, the current fair market value. So 6 million times 6% capital gains tax, that is 360,000 pesos. It must be withheld by the buyer of the property and must be remitted to the buyer. Otherwise, the title cannot be transferred to the said buyer. And the 360,000 CGT shall be withheld from the proceeds. Remember that the price is 5 million and the current fair market value is 6 million. Our tax base is the higher amount, the 6 million, which means 6 million times 6%, that is 360,000. But the buyer will withhold such 360,000 from the proceeds, from the selling price, which means 5 million minus 360, the seller would receive only an amount of 4,640,000 pesos. Assumption 2. All requirements were met and the entire proceeds was used in acquiring the new principal residence. No more, no less. So, in this second assumption, it is assumed that all requirements are met, meaning Napoleon is entitled for exemption. The sale will be exempted from the capital gains tax, but Napoleon shall be required to deposit in a bank escrow fund equivalent to 6% CGT. Again, as I have said earlier, even if Napoleon is not subject to 6% CGT because he is exempted, still, he would be required to deposit the equivalent of 6% CGT to an escrow fund. This escrow fund serves as a security in case the taxpayer fails to utilize the entire 5 million pesos proceeds within 18 months after the sale. As a security, the BAR requires that every person claiming for exemption from the capital gains tax will deposit an escrow fund equivalent to the 6%. This will be set aside and will serve as security deposit. And if the taxpayer seller fully utilize the entire proceeds, then the escrow fund will be refunded to him. But if he failed to utilize the proceeds, then it will be appropriated as a payment for the capital gains tax. On the other hand, the cost of the new principal residence will be 3 million, the same as the cost of the old residence, despite the fact that the entire proceeds of 5 million was used in acquiring the new principal residence. So take note that in this assumption, Napoleon really used the entire 5 million. No more, no less. Even if Napoleon used the entire 5 million pesos, the cost of the new principal residence would still be 3 million, as if there was no sale, as if it was still the old principal residence. Again, the cost of the old principal residence is equal to the cost of the new principal residence, which means if the cost of the old residence is 3 million, the cost of the new residence would still be 3 million. You might be asking, why is that? Napoleon used the entire 5 million pesos. Isn't it right to also record the cost of the new principal residence, an amount amounting to 5 million pesos? The answer is no, because you sold the old residence to acquire a new residence, and then the entire proceeds was used to acquire the new residence. Then in the eyes of the law for BAR, the cost of the new principal residence is still the same as the old residence. So even if you spend the entire 5 million, still it would be 3 million for BAR. Assumption 3. All requirements were met, but only 4 million out of 5 million was utilized in acquiring his new principal residence. So in this case, remember that Napoleon sold his old residence for 5 million and he intends to use that 5 million to acquire a new principal residence. But in reality, he only used 4 million out of it. So what could be the effect? The taxpayer will still be required to deposit the entire capital gains tax. Okay, it is always a requirement. If you decided to use the proceeds to acquire new principal residence, you will be required to deposit in an escrow fund equivalent to the supposedly capital gains tax, the entire capital gains tax. That is a security deposit. And since Napoleon failed to utilize the entire proceeds and only used 4 million out of 5 million, therefore, there is an unutilized portion of 1 million. Such portion shall be subject to capital gains tax. And the capital gains tax is computed as follows. So we have 1 million, the unutilized portion, divided by the entire proceeds, that is 5 million, times the capital gains tax, 360, that would be 72,000 pesos. Okay? So that is the capital gains tax to be taken out from the escrow fund. So remember that Napoleon deposited in an escrow fund amounting to 360. So instead of refunding the entire 360 to him, it will be decreased by 72,000 pesos. So the bank will be responsible for the remittance. So there will be an exemption still, but that only amounts to 4 million over 5 million times 360. So instead of refunding the entire 360 to Napoleon, 288 na lang. Okay? So Napoleon will not receive the entire 360. 360 minus 72, that is 288. So 288 will be refunded to Napoleon, but the 72 will be considered as a capital gains tax. On the other hand, the cost of the new principal residence will be computed as follows. So remember that Napoleon intends to use the entire proceeds of 5 million, but he only actually used 4 million out of that 5 million. Also remember that the cost of the old residence was 3 million. Now, we will proportionate that 3 million in respect to the amount actually used to acquire a new principal residence. So we have here 4 million over 5 million. That is the amount actually used by Napoleon to acquire the new principal residence out of the 5 million proceeds, times the cost of the old residence. So the cost of the new principal residence is 2,400,000. So when Napoleon in assumption 2 used the entire proceeds, no more, no less, the cost of the new principal residence is equal to the cost of the old principal residence. But in this assumption, when Napoleon used only a portion of the proceeds and not the entire proceeds, meaning he used only a lesser amount, the cost of the new principal residence is equal to the proportion of the cost of the old principal residence in respect to the utilized portion of the proceeds of the sale. Okay? Last assumption. All requirements were met and 7.5 million was utilized in acquiring his new principal residence. So take note that the proceeds is only 5 million. And in this assumption, all requirements were met. Meaning to say, he is exempted from the capital gains tax. But instead of using 5 million pesos alone, he used 7.5 million. Therefore, Napoleon adds another 2.5 million to acquire the new principal residence. So, in this case, the taxpayer adds certain amount of money in addition to the proceeds to acquire the new principal residence. Thus, the taxpayer will remain exempted from the capital gains tax. But again, he is required to deposit an escrow fund. Again, exempted or not, you are required to deposit into an escrow fund. This is a security on the part of the BAR that you will really faithfully comply all the requirements. So if you fail to utilize the proceeds within 18 months, that escrow fund will be appropriated to pay the corresponding capital gains tax. But if you really fully utilize the entire proceeds from the sale, then the escrow fund will be refunded back to you. Okay? So it will be refunded in full to him upon showing of proof that the sale was really exempted because he really fully utilized the proceeds of the sale. On the other hand, the cost basis of the new principal residence is computed as follows. So remember that Napoleon used 7.5 million. This is the new investment in his new principal residence. But 5 million of that is coming from the sale, the proceeds. Therefore, he actually adds 2.5 million to acquire the new principal residence. Therefore, this additional investment will be added to the cost of the old principal residence. Remember, the cost of the old residence was 3 million, so we will add 3 million and 2.5. Therefore, the cost of the new principal residence is now 5,500,000. Okay? So that's it. General rule, real properties classified as capital asset will be subject to 6% capital gains tax, except if the buyer is a government, in which case the seller has the option to subject to 6% capital gains tax or to 6% CWT. And there is an exemption. If the real property sold was a principal residence and there's an intention to use the proceeds to acquire the new principal residence. Okay, thank you so much for watching. We still have another video on the capital gains tax on sale of shares of stocks not listed in the local stock exchange.